There is a thief in your house. He doesn't break windows, he doesn't pick locks, he doesn't even wear a mask. In fact, you invited him in. You gave him the guest room. You feed him every single day. For the last 40 years, the average person was told a very specific lie about money. You know the script. It was beaten into you by parents, teachers, and well-meaning bank tellers. Go to school, get a job, save your money, put it in the bank. If you do that, you are safe. That advice is no longer just outdated, it is mathematically dangerous. If you left $10,000 in a standard savings account in 2020, by today, you haven't just kept your money. You have effectively set about $2,000 of it on fire. You didn't spend it, you didn't lose it in a casino. It evaporated while it was sitting safely in the vault. The system is not designed for you to hoard cash. It is designed to force you to move it, to risk it. But here is the problem. You are tired. You have a job. You don't have time to stare at 6 monitors watching candlestick charts. And you certainly don't want to gamble your life savings on a picture of a monkey or a speculative tech stock that loses 80% of its value in a week. You want the Holy Grail. You want passive income. But we need to clear something up before we start. Passive income is not about getting rich. It is about survival. It is the only conservative way to stop the bleeding. Today, we are going to dismantle the machinery of conservative wealth generation. We aren't talking about side hustles or drop shipping. We are looking at the financial instruments that built the old world, bonds, dividends, and debt instruments, and we are going to see if they can still save you in the new one. This is how you turn capital into a shield. To understand how to generate income without working, you first have to understand who you are in the economic food chain. When you go to work, you trade time for money. That is active. When you invest for income, you trade risk for money. That is passive. The conservative investor is someone who hates risk. You want to sleep at night. You want your principal, the original pile of money, to stay intact. So, let's look at the first and most obvious vehicle, the one everyone ignores because it's boring, the risk-free rate. In the world of high finance, everything is measured against the United States Treasury bond. This is effectively a loan you give to the US government. You give them money, they promise to pay you back with interest. For a long time, this paid almost nothing. It was dead money. But recently, the gears shifted. The Federal Reserve hiked rates. Suddenly, the boring money is paying 4 or 5%. This is the baseline. If an investment cannot beat what the government pays you for doing absolutely nothing, it is trash. But here is the mechanism most people miss. You don't just buy a bond and sit on it. You build a ladder. Imagine you have savings. If you lock it all away for 10 years to get a higher rate, you lose access to it. If you need cash, you have to sell the bond, and if rates have moved against you, you take a loss. So the conservative strategy is the bond ladder. You buy a bond that matures in 3 months, another in 6 months, another in 9, another in 12. Every 3 months, a chunk of your money comes back to you with interest, liquid cash. If you need it, you take it. If you don't, you buy a new bond at the back of the line. It is a perpetual motion machine of liquidity. It is the closest thing in finance to a free lunch. But there is a catch. There is always a catch. Why is the government paying you 5%? They aren't doing it out of charity. They're doing it because they need your money to pay off the debts from the money they borrowed yesterday. And where do they get the money to pay you back? They print it. This creates the nominal illusion. If the bond pays you 5%, but inflation, the rate at which they're diluting the currency, is 4%, Your real return is 1%. Then the government taxes that 5% gain. Suddenly, you realize the math is rigged. You aren't making money. You're just treading water while everyone else drowns. To actually get ahead, we have to leave the safety of the government and enter the corporate world. We need to own something real. This brings us to the second tier of conservative income: Dividend Aristocrats. Most people buy stocks hoping the line goes up. They want to buy at 10 and sell at 20. That is speculation. The income investor doesn't care if the line goes up. They care if the check clears. When you buy a share of a company, you are a partial owner. If that company makes a profit, they have two choices. They can keep it to grow, or they can give it to you. That payout is a dividend. There is a specific class of companies called aristocrats. These are massive, boring companies that have increased their payouts every single year for 25 years straight. We are talking about companies that make toothpaste, companies that pick up trash, companies that sell toilet paper. These businesses are not exciting. They will not go to the moon, but they have a monopoly on human necessity. Regardless of whether the economy is booming or crashing, people will still brush their teeth. The strategy here is not just buying them, it's the DRIP, the Dividend Reinvestment Plan. It works like a snowball rolling down a hill. Let's say you own 100 shares. They pay you a dividend. You don't spend the cash. The computer automatically uses that cash to buy 3 more shares. Now you have 103 shares. Next quarter, you get paid on 103 shares. That buys you 3.5 shares.
Einstein supposedly called compound interest the 8th wonder of the world. He was right. But here is where the conservative investor gets slaughtered. It's called the yield trap. You look at a screener, you see a company paying a 9% dividend. You think, jackpot. Stop. A dividend yield is a simple math equation. The annual payout divided by the stock price. If a company is dying, if their lawsuits are piling up, if their product is obsolete, their stock price crashes. When the price crashes, the yield percentage shoots up. That 9% yield is not a gift. It is a siren song. It is the market screaming that this company is in distress. If you buy it, they will likely cut the dividend to 0 next month, and you will be left holding a worthless bag. True conservative income requires you to be skeptical. If the yield looks too good to be true, it is. You are looking for the boring 3 to 4% that grows faster than inflation. Now let's talk about the asset class that has created more dynasties than any other: real estate. But we are not going to talk about flipping houses or fixing toilets at 2 a.m. That is a job, not passive income. We're talking about REITs, real estate investment trusts. In the 1960s, Congress created a special tax structure. It allows a company to own massive portfolios of real estate: skyscrapers, hospitals, data centers, cell towers. Here's the deal. The government says, we will not charge you corporate income tax, but in exchange, you must distribute 90% of your taxable income to your shareholders. 90%. This structure turns real estate into a liquid stock. You can buy a piece of the Empire State Building with the click of a button, and you get your share of the rent. The conservative play here is to look at Triple Net Lease REITs. Imagine a company that owns the land under a Walgreens or a 7-Eleven. The tenant, Walgreens, pays the insurance, the maintenance, and the taxes. The landlord just collects the check. It is a pure pass-through of cash. But just like bonds, there is a predator in the water: interest rates. Real estate runs on debt. When interest rates rise, the cost of borrowing goes up for these companies. Their profits get squeezed. We saw this recently. When rates spiked, safe REITs dropped 20 to 30% in value. This exposes the fundamental lie of passive income. There is no such thing as set it and forget it. If you are in cash, inflation eats you. If you are in bonds, you are capped by the government. If you are in stocks, you are exposed to market crashes. If you are in real estate, you are exposed to interest rates. So, what is the solution? The solution is the barbell. You don't pick one, you balance the extremes to neutralize the risks. On one side, you have the ultra-safe, short-term treasuries, cash equivalents. This is your dry powder. It pays you 5% while you wait, and it ensures you never have to sell your assets during a crash to pay bills. On the other side, you have the growth income, the dividend aristocrats in the REITs. These fight inflation. They raise their prices as the dollar loses value. You use the income from the risky side to fill the bucket on the safe side. We need to have a very honest conversation about why you are doing this. The financial industry sells you passive income as a way to buy a Lamborghini or sip coconuts on a beach. That is marketing fluff. The reality is that we are living in a period of financial repression. Governments around the world are heavily indebted. The only way they can manage that debt is to keep interest rates below the rate of real inflation for long periods or to debase the currency. This transfers wealth from savers to debtors. If you simply save money, you are the fuel for the system. You are being burned to keep the engine running. Building a conservative passive income stream is an act of defiance. It is you saying, I will not let my labor be devalued. It requires discipline. It requires you to be boring when everyone else is being exciting. It requires you to accept a 4% yield while your neighbor brags about making 50% on a crypto coin right before he loses it all. The clock is ticking on your cash. Every second it sits idle, it shrinks. You don't need to be a genius. You don't need to be a